Do you want to know how you can value a company with the dividend discount model? Then this video is the one you need to watch. You will learn how the dividend discount model works, what variations of the dividend discount model exist, and specifically how the Gordon Growth model, a variation of the dividend discount model, works in practice. In this video you will learn how to use the formula for the Gordon Growth model so you can make the calculations yourself. And unlike most other videos about this topic, you will learn exactly where you can find the information you need based on real company from the S&P 500. Hi, this is Tom from the Dividend Attitude. Today we will learn how to value a company with the Gordon Growth model, which is a variation of the dividend discount model. You'll see how the Gordon Growth model works, how to make the calculations all by yourself, including an example of a real company, and I'll show you where to get your input from. Stick around because you will also learn what the limitations of the Gordon Growth model are, what the alternative is, and as always you will see an update of my portfolio. Let me first show you an example of how some companies are valued with the dividend discount model, so the Gordon Growth variation, and then we will work backwards so I can guide you through the complete calculation of these companies. Like I said, that will include showing you exactly how and where you can get the input for the formula. I have here the same 10 companies as in the dividend yield theory video, but now they are valued with the dividend discount model. Please don't take these values as they are and base your decisions on that. There are a few limitations to the dividend discount model that you need to be aware of. I will come back to those later. As you can see, some companies actually have funny fair values here, like Visa for example. To that I will also come back later to let you know how you can make a better calculation for companies like Visa. So in order to come up with these numbers we need past year's dividends, the expected dividend growth rate and the required rate of return. In the next part you will learn where to get those numbers from. So what is the dividend discount model? The dividend discount model is a form of a discounted cash flow model to calculate the fair value of a stock by calculating it back from its future value. So the premise is that the fair value of a stock can be calculated by the sum of its future cash flows, the dividends, discounted back to fair value today with an appropriate discount rate. There are a few variations to the dividend discount model. The simple dividend discount model, this assumes zero growth in the dividend. The constant growth model, also known as the Gordon Growth model. This assumes a stable dividend growth rate forever. This is actually the one we're gonna talk about today. And the supernormal dividend growth model. This model takes into account the period of high growth followed by a lower constant growth period. If you liked the video so far, please don't forget to give the video a thumbs up and subscribe to my channel if you would like to see more content like this. The formula of the Gordon Growth model is the one you see here, where D0 represents the past year's dividends, G is the expected dividend growth rate for the long run, and R is the required rate of return for an investor. The formula for the Gordon Growth model might seem complicated, but it's actually quite simple, as you will discover. So the whole purpose of the top part of the formula is to calculate next year's dividend. The required rate of return represents the return we expect as investors based on the risk we are taking. At first we will use an arbitrary number there, and after that I will show you how we can use a method called the weighted average cost of capital, or WACC for short, to make a more informed calculation based on that specific company. So again, let's focus on Johnson & Johnson. First we need to figure out D0 for J&J. We go to Seeking Alpha and look up the past 4 quarters of dividend on the Dividend History tab, and we can see that first 3 they paid 95 cents and the last quarter they paid $1.01. So if we add those up we get to 3.86. Next we need to find out the expected dividend growth rate. Again we go back to Seeking Alpha, we go to the Dividend Growth tab, and we can see here that 10, 5, 3 and 1 year growth rate are all around 6%. So that's what we'll use for the expected dividend growth rate. So 0.6 represents 6%. And then the required rate of return. Now, like I said, first we will use an arbitrary number, and that is based on the long-term return of the S&P 500, which is 10. And we get a fair value for Johnson & Johnson of 102.29. Now, in order to be able to use this model by yourself, I need you to understand it thoroughly. Here's the formula again. We can see here that the bottom part of the formula carries the most weight, because that is the divider and it makes a huge difference if we divide by 0.04 or 0.03 for example. Let me show you. If we change the required rate of return to 9%, so 0.09, the fair value changes to 136 instead of 102. What does this mean? It means that if we want a 9% return from Johnson & Johnson, that we should not pay more than $136 based on the assumption that the constant dividend growth rate is 6%. Like I promised, we have made a calculation with an arbitrary number. Now, we will use a method that is often used to make a better estimate of our required rate of return, based on the risk and cost of capital of that specific company. This is called the weighted average cost of capital. That is a mouthful, I know. But what we aim to do is to calculate how much return a company requires at minimum to make a profit if they were to invest in a project. So a company can raise capital in two ways. Through debt, like bank loans, bonds, etc. And through equity, with preferred and common shares. On debt, they have the cost of interest rate, which is called the cost of debt. On equity, the company also has a cost to pay. It might not seem obvious at first, but shareholders require a certain rate of return from the company. Otherwise, they will sell their shares and the share price will drop, and consequently, the market cap. That required rate of return is called the cost of equity. Again, don't worry, I got you covered. We will go over this bit by bit. And if you just don't want to do the calculation at all, I discovered that on gurufocus.com you can also find the weighted average cost of capital. But I would encourage you to keep watching so you understand how it is calculated. First, the formula to calculate the weighted average cost of capital. You can see it on the screen here. So WD is the weight of debt on total capital. CD is the cost of debt, so the interest rate. T is the tax rate, because there is a tax deduction on cost of debt. I will get back to that later. WE is the weight of equity on total capital. And CE is the cost of equity. I have another tab here that is already filled in with the data from Johnson & Johnson, but I will go through each item and show you where to find it. First, we have to calculate the debt of J&J. Later, we will also use this to calculate the weight of the debt on the total capital. For that, we go to the balance sheet of J&J on Morningstar. If you are confused about how a balance sheet works, I would suggest you to watch my video on how to analyze a balance sheet first. I'll put a link below in the description of this video. Looking at J&J's balance sheet, we find that the short-term debt is 1202 and the long-term debt is 26,494. Just to be clear, this is in millions, so 1.2 and 26.4 billion. There's often confusion about this part when calculating the weighted average cost of capital, WACC. You have to understand that not all liabilities are considered as debt. In this sense, debt is all the money we owe that we have to pay interest on. For example, accounts payable is the amount we owe to our suppliers. But that is normally not a liability we pay interest on, hence why it is not counted as debt in this case. To calculate the cost of debt, we need to know how much they paid in interest. That item can be found on the income statement right here. To calculate it, we will use last year's debt and divide it by the interest expense. Dividing that gives us an interest of 1.1%. So we enter that here in our spreadsheet. So we enter 0.011 to represent 1.1%. So now we got the cost of debt part of the formula almost down. And we enter the 1.1%. However, in most countries the interest paid is a tax deductible expense. So in order to account for that, we also have to take the tax rate into account. That is what the 1 minus t stands for in the formula. Lucky for us, the tax rate can be found on the key ratios tab of Morningstar. But we can also find it on the income statement by looking at the income before tax and the income tax expense. So let's take a look at that. And here it is. So if we divide those two, we also come up with the same number, which is 12.75%. You can verify this as well by looking into the annual report of Johnson & Johnson. So again, we plug those numbers into our formula and we get a tax-adjusted cost of debt of 1.1%. So the tax deduction didn't actually make a difference here. The cost of equity is a bit harder to calculate. To calculate cost of equity, we're going to use the capital asset pricing model, or CAPM. Again, no worries, let me explain. First of all, the formula for the CAPM is where the RF is the risk-free rate, the beta is the volatility of a stock compared to the overall market, and RM is the return of the overall market. The risk-free rate is the rate of return an investor would be able to get almost risk-free. Most often the 10-year treasury yield is used for this. For this, we can go straight to the source on treasury.gov. Today, on May 1st, 2020, the yield stands at 0.64. So this is going to be our risk-free rate. Then the beta. This is easy. We can get the beta for a particular stock by using a Google function to pull it straight from Google Finance. And then expected rate of return of the market. For this we would have to look at the average historical return of the S&P 500. You can Google this, but I already did that for you, and since 1929 it is about 10-11%. So with these numbers we can fill in the CAPM or cost of equity. We get 7% or 0.07. So with the cost of debt and the cost of equity, we now have those parts of the formula. Now that we have the cost of debt and the cost of equity, we need to calculate the weight we have to give to those numbers. See the capital as a pool of money. The whole pool is the total capital, and debt and equity together make up for that whole pool of capital. So now that we have to calculate how big of a part each one is in order to do that we need to calculate the market cap. The market cap is the total amount of shares times the current market price. On the key ratio tab of Morningstar we can find that the amount of shares at the end of 2019 was 2.6 billion, coupled with the current share price of $148, that would give us an approximate market cap of 398 billion. So that gives us the equity part of the equation, and we fill that in here in our sheet. So here you can see the 2.6 billion multiplied by the current share price, which I pull automatically on the other sheet, on the other tab. So that gives us an equity of 398 billion. We already have the debt calculated from our previous calculation, so we just plug those numbers in. So the total capital is 27 billion plus 398 billion is 425 billion. And then we can calculate the weight of the debt, and we come up with 7% of debt and 93% of equity. And if you do this right, you will end up with 1, so 100%. So now we have the weight. So now back to our formula of the weighted average cost of capital, and we plug those numbers in. So the 7% weight for the debt and the 93% weight of equity. So if we calculate that formula, we get a weighted average cost of capital, WACC, of 0.076 or 7.6%. Now we go back to our dividend discount model and we plug those numbers in for Johnson & Johnson. Phew, that took a bit of work, I know. But it goes faster once you get the hang of it. And we can immediately see the limitations of the dividend discount model here, because the fair value according to the dividend discount model, so the Gordon Growth model variation, is $255. In my opinion, that is quite a high fair valuation of Johnson & Johnson, and that is because the dividend growth rate and the required rate of return are quite close to each other, so they're almost equal to 1. And that is because the required rate of return based on the weighted average cost of capital calculation is low due to the current low interest environment, making both the cost of debt and the cost of equity very low. Does this make the dividend discount model useless? No, I wouldn't say so, because this tells us that due to the low interest environment, according to the dividend discount model, we would be able to invest profitable at almost every price level, unless of course Johnson & Johnson really rises to $255. Since also for us individual investors there's no other place where we can get high returns right now, it would make sense to invest at almost any price in the stock market. So what this tells us, that according to the dividend discount model we can expect a 7.6% return until the stock reaches $255. If you remember, at the price of $136 we would get a return of 9%. It is pretty cool that in a way you can calculate how much return you could expect at what price. But remember, there are some important limitations to the dividend discount model. To get a bit ahead of one of the limitations of the Gordon Growth model, one of the limitations is that it assumes a constant growth rate indefinitely. So companies like Visa, MasterCard, Lowe's, for example, which have a higher starting growth rate that is very likely not sustainable over 20 years, can't be properly analyzed with the constant growth model, Gordon Growth model. So in order to account for that, you can use what is called a supernormal dividend growth model, which accounts for an initial high dividend growth and assumes that at one point the dividend growth will slow down and reach its long-term dividend growth. Now, I think in this video there's already a lot of information to process, so I won't go into detail about this variation of the dividend discount model right now, but I want to mention it anyway. If you want me to make a video on this variation of the dividend discount model as well, please let me know by leaving a comment in the comment section below and I'll put it on my calendar. So now that we know how the Gordon Growth model works, so the constant growth model, what are some things we need to keep in mind? First of all, companies must pay out a dividend. This one is, I guess, quite obvious. The Gordon Growth model assumes a stable and constant dividend growth. So it is most suited for mature and stable companies and not so much for companies that have fluctuating dividend growth or newer companies. And the output is very sensitive to the input of the dividend growth rate, so be careful with that. I showed you that earlier as well. If you change the dividend growth rate or the required rate of return, the valuation changes quite drastically. It is also based on a lot of assumptions, and the Gordon Growth model also fails when the required rate of return is lower than the dividend growth rate. It will return a negative value, since the lower part of the formula is required rate of return minus dividend growth rate. And of course, if you divide something by a negative number, the outcome will be negative as well. So it is best to use it in conjunction with other valuation methods, since it requires a lot of assumptions. So now my portfolio, first the one in Bing Bank. Like I mentioned in about every video, my portfolio consists of mainly dividend growth companies, so companies which raise their dividend every year, with the exception of CVS. The total portfolio value now stands at €6,811. In 2020, so far the unrealized loss is 20.3% and €1,681. So compared to last week, there's not much difference in value there. But that is okay, as a dividend growth investor we are focused on our dividends growing. And that is still happening. So far, no dividend cuts in my portfolio, so knock on wood. One thing I would like to show you this time is the reason why I invest in the US stock market as opposed to the Dutch stock market. This graph shows the performance of my portfolio since the start in 2017 compared to the performance of the AEX, which is the Dutch exchange. The difference is almost 18%. And then compared to the S&P 500 mini future since the start, you can see that the difference is still about 2%. So that's the same as last week. And then my portfolio in the Giro. In a week's time not much has changed here, although there were quite some swings in both 3M and SKT. 3M is still a bit below break even and SKT is down significantly still. It is actually very tempting to invest more into SKT at these low prices, but the uncertainty is too big for me at this point. I know the lockdown rules are slowly being lifted, but it might take a while before people start to visit outlets again in the amount they did before. And if stores within the outlets struggle, of course, they will ask for rent relief. One good thing to note is that SKT has actually increased its dividend prior to the whole situation, and that they will pay out in May, as you can already see at the bottom. Crazy thing is that at the current stock price, that would buy me like 3.5 shares of SKT. And as usual, both portfolios combined in Google Sheets. The total amount of dividends still stands at $726. The total value stands at $7,902, which is a negative 5.24% change, and a $436 negative change compared to the cost, excluding dividends. Including dividends, the change is a positive 3.47 change and $289 change compared to the cost. I've actually added an extra column to the sheet to show the beta of my positions and the beta of the overall portfolio. The beta tells me how volatile my portfolio would be compared to the overall market. So the figure of 1.04 is showing me that it is 4% more volatile than the overall market. If the market moves down 10%, in theory my portfolio would move down 14% and also the other way around. So with future purchases I really have to take a look at companies that have a lower beta to bring my beta below the 1 mark, so it is less volatile than the overall market. If you want to learn more on how to analyze a company, be sure to check out my How to Research Dividend Stocks playlist, of which I will also put a link in the description and you can click on it here in the top right corner. I've also added a list of dividend growth investing books that I personally have on my bookshelf in the description. I suggest you to watch my video on the dividend yield theory next, which you can click on here in the bottom right corner. As always, if you like this video, please hit that like button and subscribe to get updated on future videos. Next up is a video on how to value a company with a discounted cash flow model. Yes, I know, that was supposed to be this video already. So if you want to get a notification straight when that video comes out, subscribe and turn the notifications on by hitting the little bell next to it. Until next time, bye bye.